Welcome to the Pump and Dump channel for another weekly update. This week talking about the shipping industry and IMO 2020. So in this video I'm going to look at first the petrol bunkering cost, like what it costs to buy high sulfur fuel oil, which is like 3.5% sulfur or less, very light sulfur fuel oil and ultralight sulfur fuel oil. One thing to note is that the IMO 2020 compliant product is 0.5%, and then they have this ultralight sulfur fuel of 0.1, and then the high sulfur fuel oil that you can still use if you have scrubbers installed. So I was looking, of course, at the prices here because I noticed something immediately. If we just take here the last week's data, high sulfur fuel oil 3.5% is 288, and very light sulfur fuel oil is 580, which is about double the price, and then ultralight sulfur fuel oil is at 600. So you get 0.4% less in sulfur, but you only pay $20 more. And when I saw that, and also how the high sulfur fuel oil compared to the very low sulfur fuel oil, I kind of immediately noticed that there must be some arbitration if you blend the 3.5 with the 0.1%, and the math is here. You take 2 parts of high sulfur fuel oil and blend it with 15 parts of ultra low sulfur fuel oil, and you get to 0.5, and you save about 6% on the total cost versus what you have to pay if you buy the branded IMO 2020 fuel. And the same is also this week. It's about 5.5% cost saving if you do that. But another thing you can notice with these numbers is that from last week to this week, high sulfur fuel oil is increasing in price, and very light sulfur and ultralight sulfur fuel oil are decreasing in price. And the explanation for this is quite simple. It's mainly because IMO 2020 came into effect, of course, on the 1st of January, but it stipulates that vessels have to use either scrubbers if they want to use high sulfur fuel oil, or they need to use 0.5% fuel oil if they don't have scrubbers, and that is only as of the 1st of March. So into the end of February, I would assume, well, not into the end, but into mid-February or so, I would assume that the high sulfur fuel oil would keep increasing in price, and the lower sulfur fuel oils would be decreasing in price. Of course, the refineries, they have good margins. They'll have high valuations because it probably doesn't cost that much more to produce lower sulfur fuel oil than high sulfur fuel oil, and maybe it costs $50 or $100 more, but they're charging here the double. And I think that eventually these prices will come down in the longer term, but at this point in time, the valuation, of course, of a shipping company that has scrubbers installed should be higher, because it should reflect that they can use high sulfur fuel oil, and the shipping companies without scrubbers, they should have lower valuations because they have to use very low sulfur fuel oil, or they have to blend it, and it's still higher, obviously. So that is kind of something to think about. I think, though, there will be some convergence, which you can already see with these two prices. Comparing the week to week to the week to week comparison, you'll kind of see that it probably will continue going down. And then at some point, I think there'll be in the market a psychological turn where people start doubting whether installing scrubbers was really an accretive investment decision, whether this was really a good idea. Especially when the differentials decrease here, then then they'll be like panicking that they made the wrong decision to buy ships with scrubbers, and investors will be panicking because they bought shipping companies with scrubbers, and they assume that they'll be saving so much more, and then they're not. And yeah, that's kind of like the psychology I kind of see going forward. But of course, it depends very heavily on what the charter rates and the spot market is doing at that point in time, because if we take like this website here, it has the most up-to-date charter estimates, of course estimates, not factual numbers. And what you can see here is that the estimates are showing a downtrend for the bulkers, and a stable stable line for the tankers. And I think they're actually down slightly for the tankers, but you can see that the bulkers are down a bit more. And I think for the bulkers, they probably will reverse to the upside once the China-US deal is signed on the 15th, if it is signed, of course. So, the bulker rates could materially improve going forward if the market starts believing that the US will be exporting all these soya beans to China and that they need these additional vessels or whatever. But yeah, that's kind of like just hypothesizing a bit, and yeah, I'm going to switch next to the shipping companies. Talked about Nordic American Tankers before. They are known for two things I think that are very important. Number one, the CEO is against scrubbers. He doesn't think they're good because they take the sulfur and instead of blowing it into the air, they put it into the sea, which is of course a valid argument. I also don't want to eat fish that's been fed sulfur, high sulfur into their water. And they are also they'd like to brand themselves as the company that has the most spot market exposure to the spot rates, because of course everyone who knows a little bit about these cyclical volatile sectors, they know that when the market turns, the ones with the most marginal and the most exposure to the spot market will make they will make the money first, and their valuations will rise the fastest. So the reason I don't like Nordic American Tankers at this point in time is because I'm a bit more risk averse at this point in time. But I know I should not be. But I just feel I can't do it. Of course, for me, it comes down to valuation, because the vessels are being valued based upon $50,000, not 50,000, but $47,000 day rates. And they have achieved like 35 and 80,000 according to their last press release in some of their voyages. But I don't really believe that in the long term the rates will be that high. I think they will come down a bit, and then this company will see the leverage to the downside. But in the short term, I do think going into February maybe they could do very well, because as I mentioned, with the differentials between the low sulfur and the high sulfur fuel oil converging, the savings that scrubber vessels will be earning will appear to not be so material, and then Nordic American Tankers will probably come out looking really smart that they didn't put on any scrubbers, and then they'll also release the earnings, and then the earnings come out and the stock could double from here. That is a possibility, because of course with a lot of spot market exposure they could show earnings and high dividends that investors will think that are real and will be forever. And that's like the trick. You think the dividends are forever in a cyclical company, and they're not. So yeah, that's kind of where it's at for Nordic American Tankers. I'm just not feeling it. I just can't get myself to risk it. Let's say I'm not good enough, I think. Next point, DHT Holdings. I do own some DHT Holdings. They have 21 out of 27 vessels fitted with scrubbers, and they are thinking about fitting the other 6 with scrubbers, but their opinion might change if the high sulfur fuel oil keeps increasing in price, and like I just said, they'll be questioning whether it's going to make sense, just like Nordic American Tankers would be feeling smart for not having them. They have some vessels on charters, but I think they're mostly on the spot market. And the most important thing is that they, in Q3, the Q3 earnings call, which came out like October or November, they mentioned that during the bonanza, when there was like the reports about VLCCs getting $300,000 per day, they mentioned that they achieved 190,000 on one of their voyages, which was like the best deal that they made. And of course 300,000 is probably an outlier with no close second, but 190,000 is still a lot of money if you compare it to spot rates of not spot charter rates of about 50,000. So I'm very positive on this on the valuation basis. and I think the company is very well run. They pay 60% of their earnings in dividends, and that will mean that this year or next year, though, over this year and next year, there will be some increase in the dividend for sure. I think they'll be paying more than 20 cents per share in dividends, and that will probably attract a lot of people. And then, like I said, with Nordic American Tankers, the people get addicted to 6, 7, 8% dividends, and then they'll think, when the stock starts folding, when the shipping cycle turns, they'll be holding onto their shares, thinking that they'll make it back eventually with 20% dividend yields. But yeah, I think I still think I like this company. I think in the long term, it's going to have its times, of course, when it's good and when it's bad. But it really comes down to the market and navigating the market. If you can navigate the market, you just need to choose the right instrument, and then you're good. So I'm trying to play my cards with DHT Holdings for one part, and then of course with Tsakos Energy Navigation. They of course have a diversified fleet, and something important I think that will come to light when Q4 earnings are reported, similar to what DHT will be showing, is that they have a lot of spot market exposure for DHT, and TNP has some too, and they have, for most of their charters, they have profit sharing agreements in place, which means that they share on the upside. So some of the upside that is there in the market, it cannot be measured because they do not disclose what their profit sharing agreements are. So you can't like put a fixed number, you can only guess maybe, but I think it will be quite significant in terms of what this company will get. Let's say theoretically they take 30% or 50% in profit sharing, and the rates are, let's say 60,000, and if they're taking like 30% of the profit in terms of the profit sharing, and the margin between what they agree and the high end of the spot market is like 30,000, they might like take 10,000 additional dollars, on each vessel. And then there's another important thing which also applies to some part to DHT Holdings, is that Tsakos Energy Navigation, they do have, like I said, vessels on charters, but most charters are usually like 1 year long, and those vessels will come off those charters during this year for sure, and then they won't re-sign them onto new charters. They'll put them into the spot market if the spot market is still high, and then they'll also start showing that they can earn a lot of money. And that's kind of the driver for Tsakos Energy Navigation and DHT Holding for me. This is why I'm really bullish on these two, is that they have a delayed gratification element in it, and they have the doubt factor of whether the scrubbers will pay off, and that should work out, in my opinion, quite well. But yeah, in the meantime, it's going down a bit. I did sell 100 shares at 460, which is 6 cents from the high, which is something I'm very proud of, but I did not sell enough. I should have sold more, like 200. Yeah, that's kind of where I see it. I think overall this is my opinion, and always remember that it's not investment advice and or any recommendation for anyone to buy or not to buy. If you like the content, you should not forget to subscribe. If you want to leave a comment, question, or your opinion in the comment section, you can do so, and have a good day.